This is ShadowQuant, Stocks, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Friday, July 17, 2026, and this is the New York pre-market. Now, let's get into it. The Nasdaq is facing a true test of nerve today. The Nasdaq 100, tracked by QQQ, is down 1.6% in pre-market, while the S&P 500 remains relatively flat, signaling a brutal rotation out of growth and into safety. We are seeing sector-wide capitulation in technology, with the technology sector down more than 2%, while defensive staples and healthcare are posting gains. It is a classic flight to quality. But is the breadth of this decline a healthy correction or the start of a deeper trend? And with Netflix tumbling nearly 12% on news that isn't even earnings-related, we need to understand what is driving this specific fear. Let's get to work. Before we dive into the charts, here is what is on the calendar. There is not a massive macro-heavy day ahead of us. The primary event to watch is monthly options expiration, which lands on Friday, July 17th. This is the last trading day of the week, and historically, these sessions can see increased volatility as large block trades and portfolio rebalancing occur.
What to watch for on expiration is not necessarily a directional move, but rather a potential pinning effect. If the VIX stays suppressed, we might see a squeeze toward the closing bell. However, given the current volatility in QQQ, the expiration could amplify the downside if sellers are aggressive.
Beyond expiration, there are no major economic data releases scheduled for today. The Fed funds rate sits at 3.63%, and inflation data from June showed core PCE at 3.41%, but those numbers are already priced in. The market is reacting to price action and news flow, not new macro surprises. Let's look at the numbers. The S&P 500, tracked by SPY, is trading at $750.72, down 0.5%. The Dow Diamonds is holding up better at $524.83, down just 0.2%. The real story is in the Nasdaq. QQQ is at $705.94, off 1.6%. The Russell 2000, IWM, is at $295.59, essentially flat. Let's talk about the catalysts. The headline moving the most is Netflix. Shares of Netflix are gapping down nearly 12% to $65.59. This is not an earnings miss. The news is related to the club's 10 things to watch, suggesting a negative media narrative or analyst downgrades unrelated to quarterly results. This is a sentiment shock. When a high-beta growth stock like Netflix collapses on non-earnings news, it triggers algorithmic selling across the entire growth complex. Traders see the headline, and they assume the rest of the growth sector is next. It's a panic trigger, not a fundamental reassessment. Another major drop is Intuitive Surgical, ISUG, down 9.2% to $365. And in the semiconductor space, Cadence Design Systems is down 6.8%.
On the flows side, look at the breadth. We aren't just seeing selling in one name, we are seeing a sector-wide retreat. The COT data shows commercial hedgers are at their highest bullish percentile in S&P futures, which usually suggests institutional support. But here, institutions seem to be letting retail and momentum funds absorb the selling pressure in QQQ. It's a divergence. The smart money isn't defending these levels aggressively yet.
We also see massive moves in microcaps. LSBR is up 132% and FNGA is down 95%. But for the main market, the focus is on the tech bleed. Let's start with the primary driver, QQQ. It's at $705.94, approaching the low of the past 5 days, which was $702.61. Grid, what does the chart structure tell us?
The structure is deteriorating. QQQ has broken below its short-term moving averages and is testing the lower boundary of its recent consolidation. Look at the daily history. We closed at $705.94, down from a high of $713.60 earlier in the session. The 10-day range for QQQ is 700.91 to 730.83. We are currently sitting at the very bottom of that range.
The fundamental anchor is gone. QQQ is a growth-weighted index, and the top holdings are seeing their momentum break. NVDA, while still growing earnings per share, is facing headwinds. The institutional flows here are showing a distinct rotation out of high-duration assets. We are seeing outflows from growth ETFs and inflows into value. The COT data for gold is at the 100th percentile bullish, which means capital is fleeing risk assets for safety. QQQ is the epicenter of that risk-off move.
Sentiment on QQQ is turning ugly. The put/call ratio for QQQ options is at 2.64, which is extremely high. Compare that to SPY, where the P/C ratio is just 0.92. Traders are hedging heavily against a QQQ breakdown. This isn't just trading, this is insurance buying. When the P/C ratio spikes like that, it means the crowd is positioning for further downside.
But here is the risk I see. Everyone is calling this a breakdown, but look at the VIX. Yesterday, the VIX closed at 15.67. That is still relatively low. The term structure is in contango. If QQQ hits that 700 level and holds, we could see a short squeeze. However, with the P/C ratio at 2.64, that squeeze is unlikely to be powerful. The hedging demand is too high. The downside risk here is that the low volatility environment masks the fragility of the trend. Once it breaks hard.
So we have a technical breakdown, high hedging demand, and institutional rotation. Apex, how do you view this setup?
It is a classic trend disruption. Pulse data on the QQQ put/call ratio confirms that fear is entering the market. Grid shows we are testing the structural support at $702. CIPHER notes the capital flight into gold and defensive sectors. This is not a bounce, it is a regime shift for the week. The consensus is that QQQ is broken until proven otherwise.
Let's move to the technology sector. The technology sector ETF is down 2.2% to $177.52. This isn't just one stock, it's the whole sector. Grid, what are the key levels here?
The technology sector is trading at $177.52. The 10-day range for SPY was 739 to 755, and for the technology sector, the pattern is similar but steeper. We have broken below the immediate support that held earlier in the week. The previous close was lower, and we are making new lows intraday.
Let's look at the earnings context. We had NVDA report earnings per share up 121% year-over-year, which is phenomenal. Yet the stock is selling off. Amazon is up 65%, Apple is up 28%. The earnings are there, but the multiple is being crushed. This is a derating event. COT data for crude oil is at the 100th percentile bullish, and Euro FX is bullish, but equities are being sold.
The risk here is the credit spread. While equities are falling, we need to watch if credit spreads are widening. If the cost of borrowing rises, tech valuations, which rely on future cash flows, get hammered the hardest. The yield curve is at plus 0.41%, which is flat. A flat curve usually precedes a slowdown. If the technology sector breaks below 175, we are looking at a test of the 50-day moving average, which could trigger algorithmic selling from funds that use volatility targeting.
The sentiment in the tech community is shifting from buy the dip to cut the loss. The II survey might not show it yet, but the fund flows are turning negative. We are seeing a shift in the smart money narrative. It's no longer about who has the best AI chip. It's about who has the safest balance sheet. So the earnings are good, but the market is punishing the valuation. Apex, tie this together.
CIPHER point about derating is key. Grid technical breakdown at $177 confirms the selling pressure. Pulse sentiment shift shows that confidence is waning. This is a structural shift, not a noise event. The market is repricing risk.
Finally, let's talk about Netflix. Shares are down 11.8% to $65.59. This is a massive move for a large-cap stock. Pulse, what is happening with sentiment here? This is a sentiment disaster. When a stock like Netflix, which is a proxy for consumer discretionary spending and growth, drops this much on news that isn't earnings,
It signals a loss of faith in the narrative. The put/call ratio for NFLX options is likely spiking. Traders are fleeing. This isn't about the numbers, it's about the story. And the story just got worse.
Technically, this is a gap down. We are at $65.59. The previous close was around $73. This is a full-blown breakdown. There is no support immediately above this level. The next support would be the low from the previous month. The chart is ugly. It's a window of downside, meaning there is a lot of empty space above where sellers can target.
Let's look at the flows. The news is the club's 10 things to watch, which suggests a negative analyst report or a regulatory concern. If this is a regulatory headwind, it's not just NFLX. It could impact other streaming or media names. However, the COT data doesn't show massive speculative positioning in NFLX futures that would need unwinding. This looks like a fundamental shock, not a leveraged unwind.
The risk here is contagion. If NFLX falls this much on weak news, what happens to Disney? What happens to Meta? The market is looking for the next victim. The volatility in NFLX is spiking, which increases the VIX. A higher VIX puts pressure on all high-beta stocks. This isn't an isolated incident. It's a risk-off trigger.
So, a sentiment shock that is rippling through the sector. Apex, what's the takeaway for NFLX?
Pulse sentiment read is accurate. This is a narrative break. Grid technicals show no floor yet. CIPHER flow analysis suggests this is a fundamental shock, not a technical correction. The strategy here is to stay away until the dust settles. Do not try to catch a falling knife.
Let's recap. The market is experiencing a sharp rotation out of growth and into safety. QQQ is testing critical support at $702, with high put/call ratios indicating fear. The technology sector is down 2.2%, driven by a derating of tech valuations despite strong earnings. And NFLX is gapping down nearly 12%, signaling a sentiment shock that is spilling over into the broader tech sector.
The QQQ structure is broken with volume expansion on the downside, and we are testing the 5-day low of 702. If that level fails, the next support is the July 13th low at 700.91. My weekly call, QQQ bearish, target 710 by Friday.
Institutional flows are rotating out of growth into value and defensive sectors. The COT data shows smart money hedging in S&P futures and going long in gold. The earnings quality is there, but the capital is leaving tech. My weekly call, the technology sector bearish, target 172 by Friday.
The put/call ratio on QQQ is at 2.64, indicating extreme hedging demand. Sentiment is shifting from neutral to fearful as the breadth deteriorates to 1,283 decliners. My weekly call, QQQ bearish, target 715 by Friday.
The VIX is still relatively low at 15.6, but the volatility in QQQ is spiking. The risk is that the low volatility environment masks the fragility of the trend. Once the support breaks, the move down will be fast. My weekly call, QQQ bearish, target 705 by Friday.
Grid technical breakdown at 702, combined with CIPHER flow data showing capital flight to gold and defensive sectors, and pulse sentiment data confirming fear, points to a continued downward pressure on growth stocks. The rotation is structural. My weekly call, QQQ bearish, target 701 by Friday.
The consensus is clear. The tech sector is under pressure, and the weekly outlook for QQQ and the technology sector is bearish. If you're finding value in this analysis, support the project at patreon.com/ShadowQuant. Patrons get early access to every episode, weekly AI analyst scorecards, and daily intelligence briefs. And if you're listening on Spotify, Apple Podcasts, or YouTube, hit that follow button and leave a rating. It helps more traders discover the show. We appreciate you. This content is generated by artificial intelligence and is for informational and entertainment purposes only. It does not constitute financial advice. Equity markets involve risk, and past performance does not guarantee future results. Always do your own research before making any investment decisions. That wraps up this edition of ShadowQuant Equities. Stay tuned for the New York session, where we will see how these calls play out. Until then, trade safe.